Oliver, corporate insolvencies are still very low. Do you feel this reflects an underlying strength in the economy, or is it really down to levels of government support?
Well, what we see is a very weak economic picture, Chris. It's been masked by the government support there's been over the last year. I think government measures have deferred the effects of the pandemic from being reflected in corporate insolvency levels. As support measures have lifted, or as they are lifted, then we will see insolvencies rise. I mean, the ONS figures published in February reported that output shrank by 9.9% in 2020. I mean, that's more than any other economy in the G7, and that takes us back to where we were in 2013. And a recent independent survey has reported that there were 583 profit warnings in 2020, the highest for 21 years. So this year, it's not just obviously the pandemic that's been causing the problems. There's also the aftermath of Brexit, which has caused problems for supply chains right across the economy. A British Chamber of Commerce survey in February suggested that 49% of exporters had suffered problems with their post-Brexit arrangements. Exports fell by 14% in 2020, and then figures published this month show that in January, exports to the EU fell by just over 40%, and exports overall fell by just over 19%. So given this picture, it's actually surprising that corporate insolvencies were in fact 27% lower in 2020 than they were in 2019. And last year, the levels of insolvencies were their lowest for over a decade. But what this does is demonstrate the level of support there is that's been given by the government and for the economy. But already in December last year, we saw signs of change. Corporate insolvencies were up. That was the first rise since the beginning of the pandemic, and I think that trend will continue. So I think the underlying picture is concerning, and so we can expect insolvencies to increase this year.
Oliver, we hear a lot about support measures for business, government support measures for business. Some are being lifted, some are being extended. Can you clarify exactly what the position is for businesses?
Yes, Chris. I split the government support measures into three categories. What I call the direct interventions, that's things like the furlough scheme, business rates relief for the hospitality sector, and protection from eviction. The furlough scheme, as we know from the budget, is now due to expire on the 30th of September. Business rates relief, that's now due to expire on the 30th of June. Whereas protection from eviction for residential tenants, that's going to end on the 31st of May. And for commercial tenants, that's going to end on the 30th of June. Then the sort of second category are the loan schemes. Principally, that's the sort of bounce back loans, which are loans of up to £50,000 business. And then CBILS are the larger loans, going from 50,000, in some cases up to 5 million. The deadline for applying for these loans is the 31st of March, although repayment can be stretched over a number of years. For bounce back loans, you can start repayments after 18 months, whereas CBILS repayments must start after 12 months. And then the third category of measures comes out of the Corporate Insolvency and Governance Act 2020, known as SIGA 2020. That's a major piece of insolvency legislation which went through Parliament last year. And really responding to the pandemic in particular, some of the temporary measures in that bill. The most significant of those is the restrictions on company winding up. And that, again, that's something which is due to expire at the end of March this year. Specifically, what it provides is that no petition can be presented which relies on a statutory demand which is served during the relevant period, and that is a period that ran from April last year right through to 31st of March this year. And equally, no winding up petition can be presented during that relevant period unless the court is persuaded that either COVID had no effect on the fortunes of the company, or alternatively, even if COVID had not had an impact on the company's finances, the company would have been insolvent in any event. So effectively, it's really sort of stopped winding up petitions going through the courts. It's quite a high bar you've got to get over. And then I think the other sort of temporary measure I would mention relates to the new moratoriums which have been introduced. This is a new procedure that was introduced under SEGA 2020 for giving companies a short-term breathing space. That itself, the moratoriums themselves, is a permanent feature of insolvency law now. The temporary measure that's been brought in is the fact that they've relaxed the rules enabling companies to get one of these moratoriums. So you can get a moratorium without court approval, even if the company is subject to a winding up petition. But that will only last until the 31st of March, that relaxation. So looking ahead to the rest of the year, even as these measures start to expire, companies are still going to benefit from the bounce back loans and C-bills that they've already taken out. Although obviously after March this year, they won't be able to take out any new loans. But the bounce back loans provide for repayment over up to 6 years, whereas C-bills can be repaid up to 10 years. So given the amount of credit in the economy and the extension of the furlough scheme and other schemes, I think we will avoid a flood of insolvencies. However, given the overall economic picture, I think there's no doubt that there will be a steady increase in insolvencies as we progress through the year. I think we've got to remember the economy until now has effectively been frozen in time for the last year. So there will be some sort of natural wastage of insolvencies that might have occurred in any event, even without the pandemic. So all of these will have been built up as the economy's been frozen, and so they need time to work through the system. And in addition, obviously habits have changed and will change. Working habits have changed, shopping habits have changed. We're going to see significant changes in the high street, and that will result in a shake-up that will cause insolvencies, restructuring of businesses, but also new opportunities. So yeah, I think we are going to see a shake-up and a general progression as the year goes on.
Oliver, for businesses facing financial difficulties, what advice can you give them? What options do they have?
Well, the main advice I would give them is to seek advice early if they think they're in difficulty or they foresee difficulties coming on down the track. I mean, if a business is confident of their ability to trade out cash flow difficulties and in the short term, they can take advantage of one of these loan schemes. Obviously, they can't take out new loans after the end of March, but if they've already got them, then they will continue to benefit from any loans they've taken out so far. And those repayments will be spread out over a number of years. Other than that, the usual insolvency procedures are still available for companies, the CVAs, administrations, the schemes of arrangement. To these have now been added by SIGA two new procedures: the moratorium procedure that I've mentioned before, and also restructuring plans is another new system. I would just touch on these. I think the moratorium is likely to be most useful for businesses facing short-term difficulties, because these are designed to give companies a breathing space while they can sort out any cash flow difficulties they may have. And you can get an initial moratorium of 20 days without requiring creditor or court approval. You just have to file a notice with Companies House, and that can be extended to up to 40 days. Any extension beyond a 40-day period will then need either approval of creditors or approval from the court, so you'd have to apply to the court. The only other sort of main requirement is from the start you have to have the support of an insolvency practitioner who will act as what's called the monitor, and he will supervise the moratorium. And they have to be able to make a written statement that, in their view, the moratorium is likely to result in the rescue of the company as a going concern. So it's expected that the moratorium will be used as a useful stepping stone onto CVAs or possibly administration. The other system, the other procedure that's been introduced by SIGA is the restructuring plan. This is quite similar to old schemes of arrangement, and it can encompass sort of debt for equity swaps or any other sort of arrangement with creditors. But it borrows elements of Chapter 11 from the US, notably what's known as the cram down provisions, which enables a dissenting class of creditors to be overridden if in order to get the scheme approved. Ideally, the scheme should have 75% approval of every class of creditor and shareholder. But if it can't get approval from one or more class of creditors, then you can get approval from the court, which, as I say, can potentially override that class of creditors. The court to override a class of creditors, the court must be satisfied that there is at least one class of creditors that supports the scheme, and also the court must be satisfied that none of the dissenting class of creditors would be any worse off by the scheme than they would be if the scheme doesn't go through. So, in summary, as I say, seek advice early. There are many options out there, which will depend on the company's circumstances, and SIGA 2020 has added some more as well.